Before I introduce the auditors from KPMG, I want to introduce to my left Tom Zell, who is a university's assistant controller, and instrumental in developing the financial statements for this year. And I'd also like to just take a few minutes to remind you about the statements that you have in front of you. Large book, and that book consists of a number of parts, and I think it's just useful to recognize what they are. There's the first section, the management discussion and analysis, and that is designed to provide an overview of the university's financial position in 2008, 2007, 2007, and 2006. Next, we have the actual financial statements, the statement of net assets, statement of revenues, expenditures, and changes in the assets, and a statement of cash flows, and this is for the periods of June 30th of 2008 and June 30th of 2007. Along with the statement of net assets and revenues and cash flows, we also present the combined statements of the 20 college foundations, and these are discretely presented in a FASB format that's different than the format that we use for the university. GASB is the Governmental Accounting Standing Board, and FASB is the Financial Accounting Standard Board. There's then the notes to the statements, a rather extensive compendium of materials explaining a number of points about the actual statements. And finally, there's the statements for the senior and community colleges. I also want to remind the subcommittee that there are over 100 entities that sort of roll up into the university's financial statements, and these include the Research Foundation of the City University, the City University Construction Fund, the various college auxiliary associations and student associations, are the major one, and that the audit process takes about 5 months. Preparation, report, and the work of the auditors takes about the beginning of June and October. With that behind us, I'd like to then introduce partners from KPMG. Shelley Massey is the partner in charge of the audit, and Erin Shabari, who is the senior manager of the audit.
Mary had just gone through the different components of the financial statements, which I think everybody has a copy of. I have prepared a PowerPoint presentation which goes through the results of our audits, our required communications, as well as some topics in the current year audit issues. So we'll begin on page 1. I'll start with the required communications. We have completed our audit. We have issued the financial statements, and we did issue an unqualified or a clean opinion on the financial statements. We have a responsibility to conduct our audit in accordance with auditing standards that are as well as standards that are applicable to financial audits that are conducted. The reason why we need to perform this audit in accordance with government standards is because we do an audit or an A-133 audit for these federal awards, which are primarily student financial assistance. When we issue that report, we include the financial statements as well, so they need to be auditing standards. With respect to the university's foundations that Gary mentioned are included in the financial statement report on a discrete presentation as a result of a GASB standard that was issued about 5 years ago. We do not audit the foundation financial statements. They are audited by other auditors, and we do rely on their opinions as far as they are included in these financial statements. And we are responsible and do confirm the independence and the qualifications of all of those other auditors to ensure that they are independent, not only with the foundation that they are auditing, but also with the university. We did do that, and we had no exception. In carrying out our audit, we plan to perform the audit to obtain reasonable but not absolute assurance that the financial statements are free from material misstatement. And with respect to internal controls, we do perform internal control test work over all of the key business processes, including procurement, and billing, and collections. However, we do not perform enough internal to be able to opine as we do the public companies follow. Required to have an audit. We do not provide an opinion on it. We did all of the test work that we have done for internal controls with not these are material weaknesses this year. Timing of the audit is laid out here. Barry mentioned it is over quite a long period of time. We began planning in May. Our interim procedures begin in June when the staff visit all of the campuses. We perform the internal control test work at the campuses as well as our single audit procedures at that time. That takes us through August, where we have meetings with all of the college campuses to review the findings of that. And then in September, we go to the central office and we perform our year-end procedures there through October, and then we issue. On the next page, under significant accounting policies, there are no changes in significant accounting policies except for two new standards that included here that were adopted. And the accounting policies are two new accounting standards that were 2007. The first is GASB Statement Number 9, Accounting for Pollution Remediation. This statement addressed the accounting and financial reporting standards for pollution, primarily asbestos. And if an obligating event had occurred, the university was responsible for reporting a liability today for the future remediation. Was $27.9 million of a liability that was recorded as a result of GASB 49. It was a liability that was dated. The university had received 27 primarily from GASB, accumulating the information. During the year,
As loud as you can talk.
okay. The $27.9 million was recorded as of July 1st, 2007, and then there was remediation that occurred during 2008, and at the end of 2008, there was $18.5 million left of a liability that's sitting on the balance sheet of the university. The second was GASB Statement Number 50, Pension Disclosures, amendment of two pre-GASB statements, number 25 and 27, and this established and modified disclosure requirements relating to pension plans and employers of pension. And the university was already disclosing all of the requirements under GASB Statement Number 50, so this had no impact on. And there were no significant unusual transactions that were identified during the year. On page 3, we have management's judgments and accounting estimates. There are certain judgments and estimates that are embedded within the financial statements, and we have a responsibility to look at management's analyses, whether or not they are reasonable, and the most significant ones are included here. First is classifications of the different net assets. Net assets is the equity of the organization, and the different classifications include invested in capital assets, restricted non-expendable, those are the endowments, restricted expendable, and unrestricted. We do look at supporting documentation for the classification. The next is current versus non-current classifications for assets and liabilities. University classified balance sheet assets and the liabilities are classified into current and non-current. Principally for investments, there are short-term investments and long-term investments, receivables that are broken out between current and debt. And we look at supporting documentation to ensure that the classification between current and non. The next item is the presentation of scholarship allowance. The next is presentation of the scholarship allowance and expense. There are are some scholarships that are presented net of tuition, and there are some scholarships that are presented as an expense. And we look at management's determination to determine that the classification of these scholarships are appropriately as described as either, displayed as either an allowance or an expense. We did have an entry, an audit difference associated with this that's actually listed down below. We had noted that there was $4.2 million of scholarship expense that was inappropriately netted against federal government grants and contracts revenue. So this was a reclassification. We had pulled out the $4.2 million from the revenue and reported it as an expense. The next item is allowance for doubtful accounts and loans. We look at the aging of these receivables as well as management's calculation for calculating the allowance to ensure consistency from year to year. And valuation of investments. This was an area that we did focus quite a bit on this year. The marketable portion of the investments we are able to price test. We have services that KPMG can utilize to obtain third-party price quotes, and we compare those to what the custodian is using. And then for the non-marketable portion, the funds we have obtained, and we're able to obtain the underlying investments, and those are marketable, so we're able to price test those. There's actually another slide further in the presentation that describes in more detail what we've done to test investments. There's one accounting estimate that's not included here that I just wanted to mention. It is the actuarial assumptions that relate to the university's post-employment benefits. It was a new requirement to record those and disclose those last year as a result of GASB 45. And the university uses Buck Consultants to provide its actuarial estimation of these costs. And that report and all of the assumptions are reviewed by a KPMG reviewing actuary. And he reviews the report to ensure that all the assumptions that Buck is including in the report are reasonable. And just a couple of findings that I wanted to mention, a couple of nuances in some of the actuarial assumptions. For a portion of the TIAA plan for terminated and vested employees, not all of the records are available to be able to determine an actuarial calculation. So Buck Consultants has utilized consistent information for the other two, with the other two plans, the ERS and the TRS plan, for their terminated vested population. So the assumptions are based on that population, and they're utilized for the TIAA piece. And again, our actuary found this to be a reasonable approach for this. The second piece of this is that the TIAA retirees, not all of the gender information is available, so Buck Consultants utilizes female information, which is more conservative. And again, this is a very small population of this liability, and our actuary found this to be reasonable. And one other item, last year when this was adopted, the city picked up the liability associated with the community college employees that were a part of the ERS and TRS plans. However, they did not pick up the portion for the TIAA as of June 30th, 2007, but that was done during the year. So during 2008, the city university did take over the liability associated with the community college employees that were in the TIAA plan. So there was, and we will be seeing a reduction of the liability over the years as that is amortized down. So I just wanted to bring that up. As far as the audit adjustments, I did mention the one reclass that we had proposed and was recorded by the university. And other than that, there were no other audit adjustments that were proposed. On page 4, the other required communications, we have a responsibility to review information in documents that contain our independent auditor's report as well as the financial statements to ensure that the information in those documents is consistent with the financial statements. There are no disagreements with management, no known consultation by management with other accountants, no major issues discussed with management prior to our retention, absolutely no difficulties encountered in performing the audit, and there were no significant changes to our planned audit scope. There are 2 pieces of significant written communications between us and management. The first is the engagement letter that lays out our scope and fees for the audit, as well as the management representation letter. That is the letter that we received from management prior to releasing the financials. And lastly, for our required communications, we are considered to be and there were no management advisory services performed by KPMG during the year. I'm going to turn it over to Erin for the next couple of slides. Hopefully you'll be able to hear her a little better.
On page 6, I'm just going to talk a little bit about the consideration of fraud in the audit, during the audit. As it relates to pervasive risks, we identified no pervasive risks in the financial statement audit. And throughout the audit, we maintained a heightened sense of awareness to make sure that we didn't see any other pervasive risks of fraud. Specific risks presumed by Statement of Accounting Standard number 99. There's a risk of misstatement relating to revenue recognition, and also a risk of management override of internal controls. We look at journal entries to make sure that they're properly approved by various levels of management, and that's how we look at the override of internal controls. We also look at and audit significant accounting estimates, as Shelley mentioned earlier, as well as any significant or unusual transactions during the year. As it relates to any other specific risks, we did not identify any. On page 7, there's just a couple of things we wanted to highlight. They are in the financial report. There was a reclassification of the common fund. It's an investment that the university has. $202.7 million of the 2007 cash and cash equivalents was reclassed to short-term investments this year. And you'll also see that that's because the $247.8 million balance this year is also in short-term investments. The next note below explains why we made that reclass. On September 29, 2008, Wachovia Bank, who was the trustee of the Common Fund, short-term fund, resigned as trustee of the fund, and they're liquidating that fund. So, as permitted, the university has already withdrawn $241 million out of the fund, and there's still more money to come out, about 40%, but they're still waiting to get out of the fund.
Let me just amend that as of November 25th, we have withdrawn $300 million out of the fund. That's 2/3 of what we had in there. And we expect to have by December 15th, a total of $324 million. We had conversations with the Common Fund earlier this week. We participated in a telephone conference call with them, and they have indicated that by December 15th, they expect to make payment of 70%. And we're now at 65%, and expect to be at 70% certainly by the end of the year.
There weren't any issues of liquidity on any of the cash equivalents that we've had, like these auction rate securities?
No, and on the next page, we're going to go through the steps that we performed over investments, but we didn't find any
You
issues.
didn't find any of those? Okay.
Yeah, this was the only fund that we had determined to have some liquidity issues, and it was obviously universal among all of our clients who were in this.
Okay.
And I think every client is probably getting out about the same percentage.
Yes.
Yeah, so everyone's being liquidated on the same basis.
On page 8, just because investments is so significant, we laid out the procedures that we performed over investments. We reviewed internal controls, including reconciliations and management's due diligence procedures over alternative investments. We confirmed 100% of the balances with the custodians and the investment managers. We confirmed purchases and sales of investments. We performed price test work over the marketable investments, as well as investment income reasonableness tests and valuation test work over realized gains and losses. We also reviewed deposit and investment risk disclosures. We reviewed management's valuation assessment for the alternative investments and found that to be reasonable. And we reviewed the investment portfolio for any significant exposure to subprime or other hard-to-value investments. We didn't find anything significant.
This last item was a new procedure that KPMG had all audit teams where the clients had a significant investment portfolio add to their investment procedures. So we were provided with a definition of what we consider to be hard-to-value investments. Auction rate securities at a failed auction was one of them, high-yield bonds, subprime mortgages, Alt-A mortgages, which is between a subprime and a prime. And we reviewed all of the portfolios, and we did have some items that we had noted, but we were to look at the total and then assume a 50% decline in fair value, and if that number had triggered a certain threshold, we would have been required to bring in a valuation specialist to assist us in our procedures. So it did not trigger that threshold. I only think it was close. But if it had, we would have brought in a specialist to kind of look over our shoulder. I mean, not that they would have been revaluing your portfolio, but to ensure that as the audit team was performing the right procedures to ensure that valuation was reasonable.
But a lot of your information that you're getting on the investment side are derived from audited financial statements that our foundations on our campuses are using? Do you use that as sort of a secondary source to complete these analyses?
The primary information that we're using are coming from your university's Chase portfolio, those statements.
So this is so we don't aggregate the investments on our campuses into the overall.
Not the foundations.
Not the foundations.
Right, they're audited
Okay.
separately.
I know that they are, but we don't accept those audits and put them into
Well, they're
our
in
own.
here.
They're in here, but they're presented separately to this.
I see.
They don't roll up into our.
Okay.
Right, so I don't specifically audit those, I just rely on
So
the.
that doesn't appear on our balance sheet.
Not on your balance sheet, but behind it, there's a second page
I
and
see.
it appears
Got
on
it.
that balance sheet.
Okay.
But can I, just a follow-up to that, to the extent that you performed this review on our investment, did the other independent auditors perform similar exercises in reviewing the investment activity for the foundations? Did they replicate what you did in looking at that last point,
Well, we
that
don't look
service you provided?
Yeah, we don't look at their work papers to know their procedures.
Right.
But we know from their opinion that they felt everything was reasonable, or they had audit adjustments to get it to be reasonable. On the last page, there's a new auditing standard that is going to be applicable for the university's 2010 financial statements. A couple of years ago, we had a lot of conversations about a new auditing standard, SAS 112, that brought the definitions of significant deficiency and material weakness in line with the definitions that the PCAOB was using under their auditing standard number 2. However, the PCAOB a year ago amended their auditing standard number 2 with auditing standard number 5 and changed the definitions of significant deficiency and material weakness again. So in light of that, the AICPA updated SAS 112 to again change the definitions to be in line with the PCAOB. So the good news is the significant deficiency definition is changing considerably to bring in a lot more auditor judgment so that there can be a conversation between the auditors and the clients to determine whether or not they really believe it's a significant deficiency. In the past, under SAS 112, there was really a black and white line that if you had an audit adjustment or something was noted above a certain threshold, automatically a significant deficiency. So that will be changing. The definitions of material weakness are remaining relatively consistent. So no real changes there. So that concludes the presentation. Most of the new disclosures that you find in the financials were highlighted in this presentation with the new adoptions of GASB 49 and 50, as well as the disclosures that Erin had mentioned regarding the short-term fund, or some of the new items. So that highlights the financials in our audit.
Thank you very much.
All right, do we have any questions on the audit report itself that people want to go over, or are we satisfied with this summary?
Yeah, I'm satisfied. Do you want a motion to accept?
Motion to accept the audit report?
I move to accept the audit report.
All those in favor?
Aye.
Any opposed? Hearing none, it's accepted. Do we have a motion to do anything else like adjourn?
I move to adjourn the meeting.
Do we have a second? Thank you, everyone, for coming.
Good report. Thank you very much.
Thank you.
Shelley, are you getting a lot? Are you getting a lot of pushback?
To speak
with your
louder?
cli-